Investing in individual stocks is one of the most popular ways to invest in the stock market. The appeal of owning a piece of a company and watching it grow over time is compelling for many people. However, while investing in individual stocks can be exciting and rewarding, it can also be risky, especially for novice investors. In this article, we will explore the pros and cons of investing in individual stocks for novice investors, drawing on recent market trends and potential risks. Pros of investing in individual stocks. 1. Potential for higher returns. One of the biggest reasons why investors choose to invest in individual stocks is the potential for higher returns. When you invest in individual stocks, you are betting on the future success of that company. If you choose well, that company could outperform the broader market and generate substantial returns for you. 2. Control over your investments. Another pro of investing in individual stocks is that you have complete control over your investments. Unlike investing in mutual funds or exchange-traded funds (ETFs), where a fund manager makes investment decisions for you, when you invest in individual stocks, you make all the investment decisions. 3. Opportunity for diversification. Investing in individual stocks also provides an opportunity to diversify your investments. By investing in multiple companies across various industries, you can spread your risk and reduce the impact of any single company's poor performance. Cons of investing in individual stocks. 1. Risk of losing money. The biggest risk of investing in individual stocks is the risk of losing money. There is always a chance that the value of your investment could go down, and you could lose a significant amount of money. This risk is higher when investing in individual stocks as compared to investing in mutual funds or ETFs. 2. Time and effort required. Investing in individual stocks requires a significant amount of time and effort. You need to research and analyze the company's financial statements and other relevant information to make informed investment decisions. 3. Lack of diversification. While investing in individual stocks provides an opportunity for diversification, it can also lead to a lack of diversification. If you invest heavily in a single company or industry, you could be exposed to significant risk if that company or industry performs poorly. Recent market trends and risks. The stock market has been volatile in recent years, with significant fluctuations in stock prices. This volatility has been driven by several factors, including geopolitical tensions, deteriorating economic conditions, and disruptions caused by the COVID-19 pandemic. One recent market trend has been the rise of technology stocks, with companies like Amazon, Apple, and Google parent company Alphabet leading the charge. These companies have experienced significant growth over the past several years, driven by their dominant positions in their respective industries. However, investing in technology stocks is not without risk. These companies operate in a rapidly evolving landscape and face significant competition from both established players and up-and-coming startups. As a result, there is always a chance that their growth could stall or even reverse. Another risk for investors is the impact of inflation on the economy. Inflation occurs when the overall price level of goods and services in an economy increases. This can erode the purchasing power of investors' portfolios, as the value of the dollar decreases. Key terms and concepts for novice investors. There are several key terms and concepts to understand when investing in individual stocks. These include fundamental analysis. This involves analyzing a company's financial statements and other relevant information to assess its financial health and prospects for future growth. Technical analysis. This involves analyzing a company's stock price and trading volumes to identify trends and patterns that can inform investment decisions. Price-to-earnings (PE) ratio. This measures the stock price relative to the company's earnings per share, providing a way to determine whether a stock is undervalued or overvalued. Dividend. This is a distribution of a company's profits to shareholders, usually paid out on a regular basis. Market capitalization. This is the total value of a company's outstanding shares of stock, calculated by multiplying the number of shares by the current stock price. Encouraging critical thinking. Investing in individual stocks can be a rewarding experience, but it is not without risk. Novice investors should be prepared to invest the time and effort required to make informed investment decisions, and they should be mindful of the risks involved. It is also essential to remember that investing is a long-term game. Short-term market fluctuations are inevitable, but over the long run, the stock market has delivered strong returns for investors who remain patient and disciplined. Ultimately, the decision to invest in individual stocks should be based on an individual's particular financial situation, goals, and risk tolerance. By understanding the pros and cons of investing in individual stocks and staying informed about market trends and risks, novice investors can make informed decisions and build a strong investment portfolio over time.